All right, welcome to this explainer. Look, if you're a new investor, or honestly, even if you've been riding the market waves for a while, there is a massive, very dangerous trap that is incredibly easy to fall into, and that is chasing raw returns. I mean, it's human nature, right? You look at a portfolio, see a massive double-digit percentage gain, and immediately assume the strategy is brilliant. But today, we're putting on our expert advisor hats, and we're going to completely dismantle that idea. Because seriously, chasing raw returns without understanding the underlying risks, that's basically like driving a sports car at 100 miles an hour while wearing a blindfold.
I want to shatter the illusion that a high return is always a good thing right out of the gate. This right here is our golden rule. It's firmly established in the absolute bedrock of professional portfolio management. Return alone is meaningless unless risk is considered. Think about it. A 15% gain might look fantastic on paper, sure, but if you took on catastrophic, completely reckless levels of risk to achieve it, that's not a good investment. That's just getting a lucky spin at the roulette table. So before you let yourself get seduced by some fund manager boasting a flashy 14 or 15% return, there is one vital, completely non-negotiable question you have got to answer. How much return is actually being generated for the amount of risk taken? It's all about efficiency. Are you actually being properly compensated for the sleepless nights your portfolio might cause you? Okay, let's look at our roadmap for today's session. We're going to cover 1. The illusion of high returns. 2. The 2 flavors of risk. 3. The Sharpe ratio. 4. The Treynor ratio. 5. Comparing index funds versus tech. And 6. How to expose your fund manager. Let's dive into Section 1, the 2 distinct flavors of risk and how we actually measure volatility. The first flavor is systematic risk, which financial professionals measure using a metric called beta. Think of systematic risk like a massive swirling storm affecting the entire ocean. It really doesn't matter what kind of boat you're in, a luxury yacht, a little dinghy, a massive cruise ship. If the ocean gets incredibly rough, your boat is going to rock, period. In the financial world, this ocean storm represents those broad market events. We're talking aggressive interest rate hikes, inflation spikes, or global economic crises. It impacts the entire market, and literally no amount of diversification can fully protect you from it. Then we have the second flavor, total risk, which is measured by standard deviation. Now, total risk is the entire picture. It takes that ocean storm we just talked about, the systematic risk, and adds in what we call unsystematic risk. Unsystematic risk is company-specific. To stick with our analogy, it's like having a physical leak in your specific boat, a CEO scandal, a failed product launch, a supply chain bottleneck at a single factory. Those are your leaks. So when we talk about total risk, it means you are not only facing the massive ocean storm, but you're also frantically scrambling with buckets to bail out water from your own specific leaks. Which brings us to Section 2, the Sharpe ratio. This is our go-to measure for total risk. Developed by Nobel laureate William F. Sharpe, the Sharpe ratio measures the excess return a portfolio earns per unit of total risk. And remember, that means it uses standard deviation. Because it factors in total volatility, the Sharpe ratio heavily, and I mean heavily, penalizes portfolios for having those leaky boats. If a portfolio isn't diversified and is holding highly concentrated, super volatile assets, its standard deviation shoots straight up, and the Sharpe ratio plummets. It is the absolute perfect ultimate test for a non-diversified portfolio because it holds you completely accountable for every single ounce of volatility you expose yourself to. Moving on to Section 3, the Treynor ratio. This one takes a different approach by focusing on systematic risk. Developed by Jack Treynor, this ratio measures the excess return earned per unit of systematic risk, meaning it uses beta. Now, here is the absolute magic of the Treynor ratio. It entirely ignores your individual boat leaks. It assumes you've already built a well-constructed, fully diversified boat, so it only judges your performance against that unavoidable ocean storm. So, for well-diversified portfolios, like broad index funds, where that unsystematic risk has basically been wiped out, Treynor is the ideal metric to see how effectively you are navigating the broader market currents. And this table right here brilliantly illustrates the core differences you really need to memorize. Take a good look. The Sharpe ratio relies on standard deviation to measure total risk, making it the supreme judge for non-diversified portfolios. The Treynor ratio, on the other hand, relies on beta to measure systematic risk, making it the absolute go-to standard for diversified portfolios. One cares about overall volatility, the other cares only about market sensitivity. Simple as that.
Okay, section 4. Let's put these formulas to the real-world test. Index funds versus tech portfolios.
Let's compare two vastly different approaches. Portfolio A is a highly diversified index fund. It holds a broad basket of market exposures across multiple sectors, meaning it has incredibly low unsystematic risk. It's a sturdy boat, right? Practically no leaks. Now, Portfolio B is a highly concentrated tech portfolio. It's heavily weighted in giants. We're talking Tesla, Nvidia, Meta. Now, it has massive growth potential, absolutely, but it is highly volatile and carrying a ton of company-specific unsystematic risk.
So let's look at what actually happened during the 2022 tech crash. When aggressive interest rate hikes triggered a sharp, painful fall in technology stocks, Portfolio B experienced extreme volatility and huge drawdowns. Even if that concentrated tech portfolio had delivered amazing returns in the years prior to the crash, the Sharpe ratio violently punished it during the downturn. Why? Because its standard deviation, its total volatility, just absolutely exploded. The Sharpe ratio revealed that its true risk-adjusted performance had severely deteriorated.
Now, contrast that chaotic tech crash with a highly defensive FMCG, fast-moving consumer goods portfolio. Think of staples like Hindustan Unilever, Nestle India, or ITC. Look, people still buy groceries even in a deep recession. These stocks feature much lower beta, dramatically lower volatility, and remarkably stable earnings. Because of this low volatility, an FMCG portfolio often maintains a highly attractive Sharpe ratio, even when the broader market is tanking. They might not give you 100% gains in a roaring bull market, but on a risk-adjusted basis, they are incredibly efficient engines.
Section 5, and this is where it gets really fun. Let's talk about exposing your fund manager using these metrics.
Imagine you're looking at two mutual funds. Both Fund A and Fund B are boasting a stellar 14% annual return. On the surface, they look like identical twins, right? Even their beta, their systematic market risk, is identical at a moderate level. But look a little closer at that table. Fund B has a wildly higher standard deviation. And here is where you get to use your new toolkit to reveal the trick. If you only looked at the Treynor ratio, both funds would look equally attractive because, well, their beta is exactly the same. But the Sharpe ratio exposes the truth. Because Fund B has a massive standard deviation, its Sharpe ratio plummets. Fund A absolutely dominates here. Sharpe proves that Fund B's manager didn't generate that 14% through brilliant strategic stock picking. No, they generated it by taking on massive amounts of uncompensated, unsystematic risk. They didn't add value, they literally just took reckless chances with your money.
Section 6. Let's briefly touch on the CML and SML connection to round out your CFA level knowledge.
In advanced portfolio management circles, you'll often hear about the capital market line, or CML, and the security market line, the SML. So use this quick memory trick. The CML directly links with the Sharpe ratio because both of them use standard deviation to plot total risk. The SML links perfectly with the Treynor ratio because both rely exclusively on beta to plot market risk. They are simply two sides of the exact same risk-adjusted coin.
But as your expert advisors, we do have to remind you that no tool is flawless. Both Sharpe and Treynor have some significant limitations. They rely entirely on historical data. And as we all know, past performance does not guarantee future results. Furthermore, volatility and beta, they fluctuate over time. But most dangerously, during extreme market crises, like the 2008 financial collapse, asset correlations tend to go straight to 1. Basically, everything crashes together, which can suddenly make these models far less reliable.
Which brings us right back to our ultimate takeaway. The crucial point you need to remember is this. The value of a high return is absolutely zero if you don't adjust it for the risk taken to achieve it. Zero. An unadjusted return is a vanity metric. It tells you absolutely nothing about the true health, efficiency, or safety of an investment strategy. So I'm going to leave you with this final challenge. Next time you log into your brokerage accounts, look at your biggest winners. Ask yourself, are they truly outperforming, or are you just floating in a leaky boat, taking on massive uncompensated risk that just happens to be paying off? For now, go apply the Sharpe and Treynor ratios to your own investments. Strip away the illusion of raw returns and see what is really going on beneath the surface of your portfolio. Thanks for joining us for this explainer, and happy investing.